Hello, all. Thank you for coming in. We'll wait for another 5 more minutes so that all of us can join. Thank you.
We'll be starting in next 3 minutes.
Hello, all. Thank you for patiently waiting for us in the meet. Lovely to have you all here on a Saturday morning. Hope you all had a sumptuous breakfast. Today we have Mr. Balaji GR, Head of Research and Co-Fund Manager, and Mr. Ganesh A, Associate Vice President, Portfolio Management Services, heading the presentation on Corporate India Marching Forward. Brace yourself for a mind-numbing session as the presenters march forward with their numbers and data sets and insights. Wish you all a fruitful session. Now, Mr. Balaji will take over the stage. Thank you.
Thanks, Tarun. Thanks all for joining on the Saturday morning. The idea behind doing today this Corporate India Marching Forward is just now Corporate India have delivered their FY23 numbers 10 days back, right? A host of numbers have come in. We have crunched the numbers. There was 600 plus con call. A lot of conference happened. So we thought it's very important in the midst of so many things happening both in Western world and in domestic to take decisions based on data. And we strongly believe seeing data and then moving the decision is the much better way. And no better time than now because just now the corporate India has delivered. So we have crunched the numbers primarily on 5 formats in terms of if you move to the next slide, the 5 important things which I'll be covering over the next 40 minutes, me and my colleague Ganesh will cover. The first is mega trend, why we have to be positive on India, why this is a great opportunity to be in India in terms of from an investing point and so on and so forth. How has been the corporate commentary? Because as an allocator of capital, right, even though we live in India, but we make money out of corporate India, we invest into good companies with a 4 5 years perspective. So we will listen into what corporate India is commenting on both India, revival of rural economy, as well as the Capex cycle. Then we will see the third most, the item we'll be talking on ROE metric, which is a very a significant value creation number, right? So we will touch upon few sectors where ROEs are recovering, how it has been shaping, how to think about ROE, and so on and so forth. And finally, we'll get into FY23 numbers and outlook, and then obviously, right, we will take Q&A. So that's the broad outlay of what we can expect in next 40 minutes. So moving on to the first mega trend, right? Mega trend is we will talk on India and the corporate India. So if you move to the next, the biggest trend out there is India growth. And it's not just happening now, it's been happening for last 20 years, and it's been a very steady state growth. If we have to put in perspective, our GDP was 38 lakh crores during FY 2002, and we moved to 87 lakh crores. And then 272 lakh crores just ended FY23, right? At a CAGR of 9.8%, which is a nominal GDP. Obviously, you adjust the inflation, we would have grown between 5 to 6% on the real basis, right? A 10% nominal GDP growth is a significant for the size of the economy. So typically, in every 7 years, our economy is expected to double. This year, the economy is expected to hit close to 300 lakh crores. What is very important for us is one, this data, because this gives you clearly the picture, the size of our economy. We have become very significant in the world. Second, what did India consumed between 38 lakh to 87 lakh crores, and 87 lakh crore to 272 lakh crores are very different. And what we need to envisage is this year we will come close to 300 lakh crores. What India will consume between 300 lakh crores to 600 lakh crores, right, which will happen in next 6 7 years. A very significant value will be spent in a very differentiated services and the products, right? So it's all about where are we in the journey? We are in a growth economy. The data is extremely amply amplifying the evidence. But the more important is where the next 300 lakh crores is going to be spent, and then you position your portfolio accordingly, right? So that's a sum and substance. So why we need to be a long bull in India is, I think this data, if you look at many countries, right, they don't have such number in terms of consistency in growth. So moving on to the next, having seen the India GDP, how much corporate India is invested in India in terms of roughly, right? So we have just taken NSE 500 as a template. Obviously, this is not the only number, but broadly NSE 500 is a typical universe, or BSE 500 is a typical universe for any mutual fund or a PMS. Close to 80 lakh crores is what corporate India has invested. This is an equity shareholders capital. Apart from they have taken debt, but equity alone is 80 lakh crores. So really corporate India is positive. That's why they have invested. And during last year, which is FY23, the aggregate profit of this 500 companies is roughly 11 lakh crores, right? which clearly reflects corporate India have grown in size. 4 5 years back, we were doing 5 6 lakh crores, and now we are doing 11 lakh crores. Substantial, because when you make a lot of money, what happens? You will be in a position to cut the debt. You will be in a position to invest back, and that's what the data is suggesting. And I'll show some evidence on why capex cycle is reviving. Right? Keep this number. 11 lakh crores is what. Ganesh, can you just move? Yeah. And the most important thing is look at corporate India aggregate return on equity, which is close to 14%, which is a very healthy. At a country level, if our cost of equity is between 11 and 12% based on what the current interest rate cycle, we are clearly adding value. This is an aggregate picture. Definitely, few industries are substantially higher from a return on equity. And this number will tell you when corporate India invests, they are really looking for profitability also, right? That's very important, because it's not only India GDP growth will reflect into value. When the money invested and the productivity of the money is very high, that's where you end up getting actually the stock price going up substantially over a long period of time. Moving on to the next, having seen India GDP, how much corporate India has invested, where did this 11 lakh crore profit pool is sitting in, right? So in the last 3 4 years, it's been some concentrated effort in terms of by investing only into small and mid cap, we can make money. I agree. Small and mid cap tend to be a little more aggressive. They are very sensitive to economy. When economy do well, they tend to do much better than the larger ones because of the size. But you have to look at the number, right? So if I look at 11 lakh crores, the first 6 company gets 2.75 lakh crores of profit, right? So the first top 6 makes that much amount of profit. The next 16 company makes another 2.75 lakh crores of profit. So I've divided the entire 11 lakh crores into 4 just to see how much the bigger companies are making profit. And if you see close to 440 company, which is the last pie where this company makes profit. So when you have a larger projects, which like a green hydrogen or a building a metro rail, right, which needs larger capital, the larger companies are well positioned to fund these projects. And definitely in some small projects or a nimble project, right, the smaller companies. So one point I would like to convey here is every company has their own advantage and disadvantage. And I think we have to position the portfolio in a very balanced manner rather than carrying away and saying to make money, it's only in small cap. No, the data suggests very different. One clear evidence in the last 1 year is one of the best performed stock in the market is ITC, a significant large cap. I keep thinking about it was a meme stock turned to be a momentum stock now. We held to entire 3 4 years we have been holding on, right? But the whole idea is it's not that only small cap do go. When large caps are priced cheaper, it can also perform very well. So that's something I thought I'll just share upon it. Moving on to the next slide in terms of how does, so this 25 companies, right, really the major chunk of the profit pool sits in. So this is the one data I keep referring in terms of why we are positive. Where does this positivity is coming from? It's very important as an analyst or a capital allocator, right? We see by data and get positive rather than we just think we are positive. Close to 20 out of 25 top 25 companies have delivered their all-time high profit just now, clearly reflecting the deliverables of corporate India, right? So we have just marked this color in the green. If you see the top 5, right from Reliance Industries, State Bank of India, HDFC Bank, TCS, ICICI, every single company just reported the best number in their history just now. I think clearly it's same thing pointing out, right? Corporate India is delivering. If we have a capital of 3 4 years to 5 years, right? I think there is no better place than investing into an equity market. Obviously, we have to be mindful on valuation, but when corporate India is performing, right, we have to be disciplined and stay invested. I think that is where going to be a lot of wealth will be created rather than anticipating the next move. 2 months back, a lot of people had this huge negativity around what can happen to monsoon, so on and so forth, Karnataka election. But we saw a tremendous rally happened irrespective of what happened in the outcomes, right? So rather than second guessing what can move in near term, the medium term picture has to be kept in mind, because all in equity is a long term asset. I think if we are coming for a long term, clearly the opportunity lies in staying invested in the market. Moving on to next, the big picture, right? So having seen how India is performing, how corporate India is invested, how the top 4 buckets of profit pool is divided, top 25 companies are delivering, right? Finally, it matters is how is the market performing in relation to corporate India. So corporate India, which is a Nifty earnings growth, is just a template, obviously, right? It could be BSE 500, NSE 500, but we just took Nifty 50 earnings growth. For last 19 years, the earnings grown 12.8%. Remember, it's between 12 to 13, right? So India has grown 10%. Corporate India earnings have grown by 13%. So clearly, the most part of India growth is getting captured by corporate India, or slightly above 3%. The beauty is, I think this is a very rare time I've seen where the market value is very close to the earnings growth, right? So this is what we truly believe, given the medium term to long term, earnings. As long as corporate India delivering sustainably double-digit healthy growth in line with GDP, right? Expecting a lower double-digit growth is a very good expectation for the medium term. And obviously, numbers like, okay, can we do a 30%, 40%? No, I think India has delivered 12, 13. If you deliver 12, 13, right, every 6 years you will compound capital in double, right? So which is a very healthy. I think obviously as an allocator of capital, our endeavor is to deliver much more. But first of all, we should know the data about how much India has delivered, right? India has delivered 13% CAGR for a very long period. Obviously, it's not a linear return. So there are periods where your returns are very lumpy, which we saw post-COVID, right? People have made tons of money, but people just forgot we made money because a lot of people lost money before COVID, right? Because of COVID, the market price corrected. But if you adjust everything, right, I think between 12 to 14% is a very good expectation in the medium term. And obviously, a well-managed fund which can manage a risk better. That's what we try to do. And obviously, on the return, we'll show the data last just to see how we are able to do it. But the whole idea is 12 to 14 is a very good, which will enable you to double your capital between 5 to 6 years. So with that, I'll just hand over to my colleague Ganesh to talk on, having spoken about the mega trend, he will touch upon what corporate India is talking about and some more data there. And then he will touch upon the return on equity metrics, which we truly believe is a single measure to see how corporate India is doing. And then I'll come over to share some numbers. Over to you, Ganesh.
Thank you, sir. Thank you all for joining us today. A very good morning to you all. And like Tarun said, thank you all for joining us today on a Saturday morning. I know it's not easy to sit in front of teams and then listen to a bunch of numbers. But then numbers don't lie, right? Generally, it's the numbers that give you the true picture behind any specific data point or any specific trend. So to use trends effectively and make them advantages to ourselves, we definitely need to rely on numbers. So moving on to what the corporate India is talking about, right? See, we always listen to the big ones talk about what they expect from the industry or the markets. So it is very, very important to look at industry leaders who talk about what they expect out of the specific, out of overall the economy and their specific industries as such. So moving on to the first slide, which says, which talks about banks' commentary on the Indian economy, right? If you look at the biggies like SBI or ICICI Bank, the expectations on the Indian economy is robust, right? It is decently robust. So it is definitely going to be driven by investment, private investment and consumption, and it is going to be supported by improving rural demand. So what the last quarter, in the last quarter of 2023, financial year 2023, what all the biggies have seen is that tremendous improvement in terms of rural demand. Consumption is actually picking up in rural cases where even SBI and ICICI Bank, which are the biggies, which are looking at momentum in case of cement and steel output, GST collections, and even if you look at the purchasing managers index, right, the manufacturing PMI, it is at its 31-month high right now. So all these numbers are giving it, or rather, they are supported by different data, which ultimately comes to one thing, that we are at a decent growth pace. And when the overall global economy is actually getting a lot of resistance in terms of growth, we have managed to show resilience and grow very, very decently. So like I had mentioned, if you take a look at India's PMI, the latest PMI numbers which were released for May, the manufacturing PMI trend is actually looking upward, right? You can see the curve going upward. So that is how the PMI is looking, that is how the numbers are looking. And if you look at the GST collections as well, they are at their highs, right? So you can see a tremendous growth in activity and good demand coming back into the picture, which is poising India for a decent growth in the future. So the manufacturing PMI is definitely an indicator which supports the narratives by all these biggies like ICICI Bank or SBI. And similarly, rural recovery, right? If you look at FMCG companies like Dabur, HUL, Pidilite, they have observed that the last quarter of FY 2023 has been showing a lot of green shoots, right, from the rural markets, because rural markets are a very good indicator of how the economy is performing. And we've had a little bit of a trouble in the last few quarters with respect to demand from the rural markets. But then is this going to be a complete recovery? Something that we will have to wait and see. But then if you look at rural growth, it has been performing very well in the towards the last quarter. And obviously, if the biggies are being upbeat about rural recovery, it is important that we as investors take a step back and take note on the same to make sure that we are on the right pace. Like Mr. Balaji had mentioned, it's about making big companies, or it's about the path from making a big company become bigger, right? So if we want to become a part of that journey, we ought to be having a good vision on what these biggies talk about. And it is upbeat, definitely. And the Capex Positivity, if you look at L&T or ABB, they've had their highest ever order growth and highest ever order books, right? You can see L&T doing really well in the last couple of quarters. And even in terms of how they've performed in terms of profitability, they've done very, very well. And all this is supportive of whatever we saw in terms of data as well. So they're not just individual companies which are doing well, which are the industries and the industry leaders which are doing well. So it is a set of different variables put together performing very well for us as an economy. And we always have the Indian GDP numbers which outdid the estimates, which are a testament to all this. So moving on to what Mr. Balaji was talking about in terms of ROE, right? So this is a very, very important metric, right? The return on equity is something that you measure a company's profitability over a period of time. See, only when you put the bases together and understand what you need to compare each company with, you begin to get to ratios. And ROE is such a ratio which is very, very useful for you to compare the growth of one company against the other overall in the industry, right? If you look at the auto sector, which is a cyclical sector by nature, right? If you look at how we have plotted this data, it's the green shoots, right? It's those green highlighted cells are those cells which have had, or those companies on those specific years which have had a growth of more than 15%. So if you can see the auto sector, it's by nature, it is cyclical. So the 15 plus growth with all these big companies or the industry leaders that you see on this chart, you can see that it is a little bit off, right? It's not completely green, it's not completely white. It's a mix of both white and green, right? So if you look at the period from 19 to 23, you would see a lot more whites than green, right? But if you look at FY22 and 23 separately, you can see that the uptick, the revival is coming back in terms of profitability. So this is expected to deliver. I mean, the ROE is expected to be consistent across multiple companies in the future as well, because the focus is on the ROE recovery to generate positive shareholder return from the auto sector. Though the sector being cyclical, are things changing for the auto sector? Because auto sector is a great indicator of how the economy is going to perform, or how the economy overall is performing. And we see a sharp revival in terms of ROE during FY22 and 23, and it will be definitely interesting to watch how it does in the future. While things with respect to growth are lined up perfectly, right, with respect to profitability as such. And similarly, capital goods is again a very, very cyclical sector. You can see the same trend happening with respect to FY22 and 23 numbers. You know, the significant, and it's much more significant than how the auto numbers have shaped up, because this is an investment period. And you can see the numbers or the green shoots being much higher or much more significant in FY22 and 23. So there's a clear revival that is happening in the capex cycle. And it is important as investors to take note of all this to make sure we are at the right end of the cycle. And it looks like we possibly are. Now we've looked at a couple of cyclical sectors. Let's move on to something which is pretty consistent over a period of time in terms of profitability, like the consumption sector or the FMCG sector. So you can see that if you compare the auto sector or the capital goods sector's charts with this chart, you can see that most of the cells are green color, right? So there has never been a problem with profitability in terms of FMCG companies or the FMCG industry as such. So you will, if you're part of the overall industry, you will get a good chunk of the profitability attributed to you. But then the only problem or the only expectation from FMCG or consumption is the growth that is expected in the next couple of years, right? In the next couple of years, how rural demand shapes up, how it should contribute to our overall consumption economy is something to be watched closely. And from where we are at today, we are at a operating profit growth. So where we need to look at is the operating profit growth metrics, which need to improve for FMCG companies, which are again something which are at a very good stature or at a very good stand today. So when that happens, right, you will see that the consumption sector also going up. And with respect to any specific pick, right, whether it's the auto sector with respect to capital goods or FMCG, it's important to make sure that you are in the right idea, because as an industry overall, things might look rosy or things might look growth oriented, but then it is important to be very bottom up with your approach to make sure that you're in the right set of companies to ensure that you make sustainable returns over the long term. So something which is similar to FMCG is the IT sector, which has recently gone through a little rough phase, right? The IT sector is not as such in the limelight with respect to the hot stocks of the season and all that. So people are a little bit ignorant of how IT sector has actually performed over a period of time. So it's a consistent sector which has actually delivered more than the cost of equity consistently and sustainably, right? So this is a sector which can ideally give an opportunity in. So whenever there is a little bit of a disturbance, right? Whenever there's a little bit of hurdle, that's when you get your assets cheap. So with respect to information technology, that we believe that we are at a stage where the assets look cheap right now and are poised for good growth or ideal growth of 10 to 12% over a period of 5 years, right? So that is what we're looking at from an industry like information technology. And over here as well, it is very important for you to be bottom up and stock specific or idea specific to make sure that the returns are sustainable over a period of time. With that, I would like to conclude my presentation on this session, and I would hand the mic over to Mr. Balaji to continue with the BSE 500 sector numbers on corporate.
Thanks.
Yeah, thank you, sir.
Thanks, Ganesh. Just go to capital goods ROE. I have just a point to add. If you can go to capital goods. Yeah. So if you see, right, there is every sector has its merit. I think the whole idea about putting this data is there is a view that we have to buy consumption theme at any price because they are free cash flow generating and so on and so forth. But I'm sure every sector has a relevance, right? If someone doesn't even build the house, who's going to be part of a tenant, right? So the question is, every sector goes through a cycle. Some sector goes through a very deep cycle and some sector goes through shallow cycle, right? So auto is a slightly a shallow cycle industry. Capital goods is a very deep cycle, right? Economy has to do very well. And if you see the last decade, predominantly they lost out, right? A lot of people just forgot there are companies in capital goods which are really doing good engineering work. But India was not growing at a rapid pace because of our own problem. We started with a very high inflation in FY 12-13. Then we ended up having our own set of problems in DeMont, GST. Then we had DHFL issue and then COVID, right? So there were so many things happened in the last 7-8 years where the growth was always coming and going back, going and coming back. But now finally we are seeing a revival, and that's where if you see the action is completely shifted from extremely consumption oriented to investment oriented. So the whole point of sharing two sectors of cyclical and two in profitable is every sector has a relevance, and we have to position the portfolio accordingly rather than saying consumption is the only way, consumption is always a flourishing. That's not the necessary. I have some more data to share. And if you see IT, right, Ganesh, can you just move to IT sector where generally very profitable? I mean, you name the 30th or company also, right? They generally tend to be very profitable. So when do we buy these assets, right? So when these are very profitable, high free cash flow, right? So if you see TCS, which got 44,000 crores of profit this year, and they paid out 45,000 crores of dividend to the shareholders. So typically, they pay out all the money they generated to the shareholders because they just don't need any capital. It's a service-led business. So when we have such a fantastic business, high free cash flow, consistently profitable, not 1 year, 2 year, across 20 year, right? The way to pick up these assets is when they go through a temporary problem, and one such now phase we're going through, right? Whenever the West slows down, you see the momentum loss in operating business. And but if you're a 4 5 years investor, right, this is where the opportunity lies. So we have shared all the four sectors primarily, not this only four, but we thought these are four broad representation to tell every industry has the relevance. Certain industries are always profitable. Certain industry goes through cycles. A good mix of a profitable industry and cyclical is what a great composition, rather than saying I'll only stick to highly valued consumption theme. And now obviously, right, last 2 years people are seeing the heat. There is a particular portfolio is underperforming, and there are particular portfolio hitting all-time high, right? Because it's a bipolar market. So a balanced portfolio is what we endeavor to do over a period of time in the portfolio. So moving on to having seen the mega trend, having seen the corporate commentary which Ganesh has spoken, and having seen the profitability, right? Finally, next 10 15 minutes, I'll just touch upon the numbers, which is like FY23 numbers and the commentary. Then we'll take the Q&A. The big picture, the BSE 500, 500 companies aggregate sales for the year is 138 lakh crores, right? So we have seen India does 272 lakh crores. The 500 top big company does sales of 138 lakh crores, and they have grown at 25%. Far significant. That's what I'm saying, right? The numbers are coming, but we have to take this number with slightly pinch of salt because huge inflation we have gone through. So they have passed on the inflation to us, right? Personally, I think all of us have faced high inflation during last 1 2 years. We can cite many reasons, but inflation was real and it was passed on. And that's where we are seeing a little more elevated, but I think the numbers are very robust. And it has not only come from small cap or mid cap. Actually, the large caps have grown faster than anybody. But I think everybody have grown a healthy rate. Anything 4 5% above India GDP, we would generally consider as a very healthy companies or the segment. I think all the segments are firing. That's where the positivity is coming from the data. So this is the first data I would like to share. The sales have grown across large, mid, and small. So if I double click the same data, right, 138 lakh crores. Moving on to the next slide, we'll just go by see the sector wise. Now we have seen the segment wise, right? So crude oil basically being a commodity has done significantly well because of the price went up and then came down. Banks did a phenomenally great job. Last year was a Cinderella time. I'll share some more data when I come to Outlook. Automobile revived strongly post semiconductor chip shortage issues. Opening of economy, right? So we saw a huge revival in commercial vehicle, passenger vehicle. Only the soft spot is a two-wheeler, and I think finally with construction activity picking up, which will flow back to the rural economy and a decent monsoon, because our reservoirs are 24% more than, I think water reservoirs are pretty solid this year. I think we should have a reasonably good revival in rural, which will lift the two-wheeler, right? IT did a good job because of currency depreciation. So every sectors have grown. Obviously, few sectors have grown much faster than the other. So this is from the sales, right? So sales from a lot of sectors have done. It's not again one or two sectors doing very well in the economy. The economy is very broad based, because when it is get broad based, the investment opportunity is also broad based and not very concentrated. During the last cycle between 2014 to 17-18 cycle, where we saw a huge re-rating on this consumption theme because India disappointed in many sectors, have disappointed, and what happened? The money flew into a safe haven place, right, like an FMCG or a consumer facing. And today they're trading between 60 to 80 to 90 multiples on a 1 year forward or a trailing for earnings, right? Significant premium to their own historical average. But if you see when the economy is getting broad based, the opportunity lies not only in one theme, right? It lies in multiple theme, and that's where we believe next 4 5 years a well positioned portfolio on multiple opportunity will capture India growth, and that's where we need to ideally be there. Moving on to next, having seen the sales, which is significant, a slightly disappointing number, but obviously I'll touch upon, double click and see why. Profit have grown 10.9 lakhs. This is BSE 500. So that disconnect of 10,000 is between NSE 500 have done 11 lakhs and BSE 500 have done 10.9. No, we moved to more before one slide. Sorry. But if you see, right, they've grown 3% primarily because margin pressure was significant during last year and a few cyclical sectors were down, right? So if I remove the cyclical part, which could be your cement business did a very tough during last year, your metal business was tough because of a global slowdown, and oil also had corrected a bit, oil and gas, right? So if you remove this, I think broadly 10-12% growth was there, but on an aggregate, it's only 3%, right? So again, when you invest, we need to invest into sectors and portfolios which is going to grow. And large caps have done 1% primarily due to the large sectors like iron and steel, cement was down. Mid cap did decently well, small cap also decently well on profitability, but much, much lower than what the aggregate sales. So this next 2 years is all about revival of margins, right? So the big theme is coming out very clearly. India sold well. Now India should sell better, which is the margin. And I think many sectors are poised for margin recovery, which you will start hearing from the Q1, Q2, Q3 commentary, right? So moving on to the next, the data is not that bad at the disaggregate level when I double click, right? So that's where I say the headlines can mislead a lot. And when you see, right, banking is our core engine from a two reason. One, it's like an oil, right? If it doesn't have a sufficient oil, the vehicle doesn't move on like a petrol. And 37% of our index is banking, right? So when banking does well, generally index tend to do reasonably well. That's what we are seeing it. And that's a Cinderella time, right? They've had a record profit. Banking reported a 40% growth in their profit growth during the last year. And that's come from all big banks, right? From SBI has become a 50,000 crores profitable company. From 4-5 years back, they actually reported a loss, right? A significant revival in a few PSU banks clearly shows the economy has come back strongly. The biggies like ICICI, HDFC, Kotak continue to do what they have been doing. So fantastic numbers from bank. Crude oil, right? It's a commodity, right? So they will have swing factor. That's where the big drop of 50,000 crores of profit has happened in crude oil from 1.7 lakh crores, which is the third row, to 1.22. IT decent growth. Auto came back extremely solid. So I've highlighted few places in green. If you see, banks have grown significantly. Auto has grown very significantly, right? Primarily due to commercial vehicle and passenger vehicle revival. And as I just told, two-wheeler is about to revive. Tractor is done extremely well. And that's got reflected even in Mahindra. The biggest blockbuster of last year was hospitality. People cursed a lot of companies saying you put hotels and nothing is productive. Now I think India is all out going to tourism and really they have come back strongly, right? They have grown in tremendous. So yesterday there was a CI conference and Mr. Anant Nageshwaran cited pre-pandemic hospitality sector had 4 crores of people working. During pandemic, it went to 2.9 crores. So close to 1.1 crore people lost jobs. But as we speak today, as on yesterday, right, that's what the data was shared, close to 4.5 crore people are working, right? Really strong revival has come back in hospitality. It's a very labor intensive industry and it's good for all of us, right? Because that's where the economy will chug. Paper industry also gone through a very good cyclical upturn. So if you see from an industry point, the few industry did extremely well and few actually knocked down big time, right? Which could be oil, there's a commodity, it's a natural part. Metal, primarily, right? Global economy slowed down, so the prices got corrected. Iron and steel, construction, which is cement. So basically, if you see, deep cyclicals went down, but few cyclicals like hotel and auto, right? That's where the portfolio's position is very important. Few sectors are done really well, and that's the overall data for you. Having seen the sales and the profit, there is one more metric which we track, and this is a very insightful metric in terms of the number of company, right? The 500 company we plot in terms of sector-wise, how many, and how much high growth to low growth. So it will give you a very good idea in terms of when as an analyst or a fund manager, is it the sector is creating the value or the stock specific idea, right? So I'll give you two examples. If you think banking, 27 stocks, 22 stocks have delivered a profit growth more than 20%, right? So you saw 3% growth at the aggregate. India is growing at 10-11%. Profit growth of our banks, 22 banks have grown more than 20%, significant growth, right? Vis-a-vis, only 3 banks have actually degrown. So if you see, right, here you're getting the sector call is more important, right? The sector did extremely well during last 1 year. That got reflected in the stock price. So 7.3:1 ratio. So for every 7.3, one company which did extremely well, one company did pretty bad. A very healthy ratio. So sector, if you would have got right in banking, it was a great call. Similar to automobile, for every 5 company did extremely well, one did not do, right? So basically in banking and auto, what we should have done precisely is be in the sector, be slightly overweight and capture the growth. But if I see healthcare, right, the large one of the large sector, because you have close to 46 company, the number is 0.6. So clearly reflects for every 0.6 good company, there is one company which has delivered disappointed a lot. So here, the stock specific idea has actually worked well for a lot of people, right? So when you again double click and see the data, there are sectors where the sectoral call is very, very important, because when you have a tailwind, all we need to do is allocate reasonable capital at right valuation and allow the tailwind to take care. Where it is a mixed, the whole idea is bottom up investing comes into play, right? So, but at aggregate, for every one good company, which is the 500 number, if you see on the right bottom, for 500, it's 1.1:2 ratio. So for every strong one company, there is one weak company. So the opportunity for all of us is when this weak company were to come back, and if we are investing in the right place, right, we'll be able to capture. So I think people asked, markets are close to all-time high. Is there enough more opportunity? The opportunity is not 500 companies have performed. Then it is very difficult to find a new opportunity. The good news is exactly half the universe is performing and half is not performing. And that's where the opportunity for all of us there to deploy capital and then make money in the medium term, which could be 4 to 5 years. So the last slide, I think a lot of data have gone in, I'm sure, is this is a very important metric. Again, coming back, the number of companies have grown more 10% on top line and the bottom line. This is one number I keep measuring, which is 255, right? So close to 255 companies have delivered minimum 10% growth, which is more than nominal GDP and both sales and the profit. So Indian companies are not one company, one sector, multi-sector, multi-companies are performing. But the opportunity lies in that 44, where both sales has not grown and profits have not grown, but few companies can revive, right? Because as I told in the beginning, every sector has their own relevance, and when they come back, you will start seeing the merit. So close to 190 companies have not done anything meaningfully from sales growth. And when they revive, which is primarily from rural economy, which is the one soft spot within the economy, there is going to be definitely a good opportunity opening up. So I think clearly with all this evidence, one thing is very clear. India is reasonably doing extremely well. I think as Ganesh alluded, it's a context matters, right? When the world is growing at 1 to 2%, and when we are growing at 6 to 7%, I think the Q4 numbers surprised, right? Because for FY23, we have grown at 7.2. It clearly reflects a very healthy economy. But for all the surprise, GDP gets revised 6 times. So I think the final number we'll get to know in FY25-26. But the confidence is the first 2 months of this year also clearly reflecting, which is reflecting in GST collection and so on and so forth, a very healthy trend. So having seen all the numbers, next 5 minutes, I'll touch upon the broad outlook and then we'll open the questions, right? So I'm sure a lot of numbers have gone in. If you move, Ganesh, to the next on it, banking 37%, right? It's a very, very important sector. Be mindful when such a large sector out of index does extremely well, your index tend to do reasonably well. That's where having a pessimistic outlook on index is not a great way. They had a fantastic show last quarter and last year was really good. That's primarily they have grown the loan book. Their NPAs are very well controlled, margin improved. So broad expectation is the coming year is between 12 to 15% growth, which is a very healthy growth, I would say, because if you see pre-pandemic, banking were being growing between 8 to 10%, right? Very slightly suboptimal. Now the growth has picked up, which is very, very healthy in nature, right? Because India is doing 10 and banking is doing 12 to 15. So I think the topmost engine is going to fire at a reasonable rate. That's point number one. So if we go to next slide, as I told, right, if you see the two things I have marked, all the big banks have grown between 15 to 20%, right? So what is happening is the biggies are getting bigger. That's where the opportunity doesn't only lie in small caps. So be mindful. The numbers are saying the big guys are also capturing India growth much, much faster. So there is always opportunity in every segment of the market. And look at NPA numbers. Why we have pretty confident reasonably in the medium term is for any economy to do well, you need two engines to be really, really clean, healthy. The first engine is the lending engine, which is the banking. They've gone through huge NPA crisis. And now if you see all the big banks, right from SBI, ICICI, Axis, HDFC, Kotak, every bank's NPA is less than 1%. Clearly reflects they are in extremely solid position from lending ability, right? So they can lend very well. And on the other side, corporate India, which takes money from the bank to build India, is also absolutely become reasonably debt free, right? Predominantly, they're entirely done the deleveraging. So we have the two strong pillars for a sustainable growth for next 5-7 years. Moving on to next. Banking profit, as I told, it's a Cinderella time. The aggregate banking profit is 2.4 lakh crores. If you see 5 years back, the aggregate banking profit pool was loss. So that's where I'm saying this cycle is going to be stronger. We have seen a tremendous recovery of profit pool of the bank. And to give one evidence, which was like so exciting, the last 10 years, every single year, there is at least one bank reports a loss. It is a norm, right? Banking is a leveraged business. A mistake can lead. This is the only year in the last 10-year cycle, not even single bank have reported a loss. Clearly a Cinderella time, as Mr. Uday Kotak told, things are doing good. So we'll keep our fingers crossed. So it's a Cinderella time. Our core engine is firing, and it's a big part of our economy at the operating level, at the index level, right? So this is for you, 2.4 lakh crores from a technically loss in 5 years back, right? Clear swing. And if you see in SBI, the proof is 3,000 crores or a loss to a 56,000 crores of a profit. Significant revival. Obviously, this revival has not only come because of SBI, definitely economy is also doing its part. Moving on to next, this is on the banking. IT 13% weight on the index. It's a mixed bag, obviously, right? They lost margins. They're growing at reasonably pace. But good news is attrition has peaked. Post-COVID, there was a huge problem of retaining people. And today, I think with some stability, that's peaked. Near-term outlook is slightly cautious, obviously, right? With Western world going through a slowdown, we are yet to see the rates peaking, right? So in the last 3-4 months, people perceived the rate got peaked. But all of a sudden, we saw Australian Central Bank and Canada Central Bank have raised rates. So there is a slight concern in terms of where are we in the rate cycle. But broadly, we believe these are good industry, money-making industry. As long as you buy this industry at the right price, compounding capital is a fantastic way, and this is a high free cash flow business, right? So we are reasonably positive in the medium term on this industry. Moving on to next slide. Auto, as I told, fantastic revival. Definitely, all the segments got revived. The only segment which is lately soft spot is two-wheeler, and the month of April and May, clearly the data has come out in terms of the way it's slightly picking up and the construction activity. So for two-wheeler, the rural economy is very, very significant. And for rural economy, one of the biggest industry getting revived after 7 years is real estate. And that's for real, right? The top 7 cities are firing, and I think it's broad-based. When the construction activity picks up, the money flows back into rural apart from your actually agri-led income. So I think next 1 year, the story will be activity-led, infrastructure activity-led, flow money back into rural and then revival of rural. And that's where some opportunity lies here. And few of the stocks have actually hit the 52-week high in last week, right? So slowly we are seeing some interest is coming in a lot of two-wheeler names after a very long time. So one company hit 52-week high after 870 days, right? So very, after a long time, the revival is happening in this segment, something to watch out. There is a management change in a few companies, and there is a capital allocation change in few companies. So there are definitely some interesting times that are happening in some of the few names, at least. Moving on to next, FMCG, I think this year will be a year of volume growth. They're not going to have a price hike. They'll be spending a little more on advertisement. I think revival of rural will also support FMCG, right? And actually FMCG index is close to all-time high. As I just told, the meme stock turned to a momentum stock, right? So clearly, as an allocator of capital, all we need to do is, these are always money-making industry. When you can buy assets for cheap, right? When the stock was trading at 200, the free cash flow yield was close to 4 to 5%. I think the numbers were always positive for this company called ITC, and the reason was there was concern on FI selling, there was concern on ESG, and these are a lot of non-fundamental reason. And when that went away, we saw a doubler of a large cap, right? So clearly reflects A few opportunities are opening up here because growth is about to revive. Stocks have not gone anywhere in the last 2 years. Broadly, they have been in sleepy mode in terms of broadly, at least except for a few stocks have rallied. So I think this opportunity is opening up. We need to be mindful on valuation we pay, but I think the growth will revive primarily due to volumes. Moving on to the last segment, which is capital goods. Pharma before capital goods. I think obviously, right, it's one such industry where there are a lot more business model, lot more industry. So you have India-centric company does 8 to 10% like an FMCG, right? They're very profitable. No surprises there. US is always in surprise, but the good news is the product cycle in US is getting revived. Some bit of a margin pressure reduction is seeing it because of drug shortage. But it's very, very cyclical. So obviously we have to be mindful on what type of a name we play, where are we in the cycle, what product cycle. So margin recovery is something which clearly will be seen in a lot of pharma name because they lost a lot of margin. For them, margin recovery will be always when the inflation hits for them, they will not be able to pass it on immediately because it's a very sensitive product, right? So I think this year will be a year of revival of margin there. The outlook is, if you move to next, the outlook is reasonably positive. Obviously, it will be case specific. India, your expectation is 8 to 10. And globally, wherever the good product cycle, we can tend to be positive. But the good news in pharma is all the big companies' balance sheet is cleaned up, right? After the entire mess in 2015, 16, 17, where a lot of companies went for acquisition, they bloated the balance sheet, they had debt. And now, if you see the top 10 is in pristine balance sheet, they are little more disciplined in capital. So I think definitely an industry to watch, but it's going to be a lot of more swing factors, right? It's not easily predictable, at least. Moving on to next, the last sector which we would like to touch upon is capital goods. The story is really, really solid. It's firing in all cylinders after a long time. Order placement has been good, record book order for a lot of companies. They had some bit of a margin pressure for few players because of the early contracts, but now since the contracts are getting over and the new contracts are coming with a revised price, general outlook is very, very positive. This coming from multiple industry, multiple segment, both Indian companies, both MNCs. I think this is one sector where clearly revival is very, very robust, right? And I'll share a little more data to support this argument. Obviously, stock price have run up. We need to be mindful on what type of a stock we buy, how much we pay up. But the whole point is if the portfolio is extremely positioned to non-capital goods, right? You're missing some action. That's the whole point with what we want to share it. So moving on to next, we looked at this interesting data in terms of how many companies in this sector has grown more than 20% every single year, right? So is the Capex revival is real? So during FY 2015, 6 companies only grew at 20% operating profit growth, right? Out of close to 25. So not a big number. And then the slowly revival was happening. Then came COVID. But now if you see 14 companies out of 25 have grown more than 20%, right? So we have seen clearly profit growth is only 3%. But if you see capital goods, almost every 60-70% of the company have grown more than 20%, clearly reflecting the underlying momentum on a much, much broader base, right? Skip this data. So I have some other data to share in terms of how the portfolio should be positioned and where are we in the cycle. The last before slide in terms of if your core portfolio is still filled with expensive consumption theme, right? Think about it because move on to you, Ganesh. Just make up more. Look at this. So we just plotted 2 stocks. One is consumption leader, absolutely strong leader, no doubt. Another is an investment leader, right? The whole point here is if we have to pay 80 multiple on a consumption, which is growing at 12-15%, and not paying a 50 multiple or 40 multiple, but the growth rates are 40-30%, right? And clearly see last 2 years, the whole idea is to show that there is a bull run happening in one place and there is no bull run happening in another place. And the difference is close to 150% return in 2-year time, which is both are highly well-run company. One is MNC, one is domestic. Both are leaders. One is consumption, one is investment. So the message is simple. Different themes give very different opportunity based on economic context. When inflation is hit, right, government policies cannot support consumption because you're going to reinforce more inflation, right? So that's where the entire focus on the entire block is investment-led growth, because once you improve the supply side economy, you are not going to have a big inflation. So position the portfolio accordingly so that we can capture India growth. So that's a message. If you're still sitting with your existing portfolio, which is fully filled with consumption theme, think about it. That's only your honest thought about in this slide. Moving on to next, having shown the entire thing, the last question, which is a natural question, Balaji, do we have enough opportunity to invest? We strongly believe there are pockets of opportunity. Moving on to next, I'll share a data in terms of where the valuation, right? So it's a very interesting data from Jefferies. Jefferies published this report last week, and I was looking at this report. Last 18 months, markets have been in a similar place, right? That we know. But what we don't see daily is the valuations got corrected. Today, we have very reasonable valuation. So our Nifty EPS for the next year will be around about 920 to 950. So we are trading between 18 to 19 times, whichever way we look at, right? So we're not very expensive. So that's a point number one. The most important data is the second one, where the Nifty PE premium to Asia economies ex Japan, we're very close to average. So what does it mean for an FI? Now India is trading reasonable, right? Because for this money has not come back in the last 2 years. They just started drilling. I think slowly we will start seeing more money coming in. And as the economy revives and then we go through general election and we go through this entire uncertainty, there is a big opportunity of FI coming back, and then we see a substantial rise in the overall right companies for right valuation, right? So definitely the opportunity lies here. One opportunity lies in rural revival. The second opportunity is FIs can come back very, very strongly because valuation has become reasonably benign than 18 months. Where India has grown, corporate India has grown, the markets have been similarly at that level, at the broad. Few stocks have gone up, few stocks have come down. Seeing the next data, very interesting data from Motilal. This is Motilal institution. Like half the large cap index stocks are trading much, much reasonable than the historical average, right? So let's take the case of HDFC Bank. This bank used to trade between 3 to 4 times book. Today it's trading at 2.7, right? So instead of saying that markets are all-time high, there is no opportunity, we have to keep doing this double click and figure out where is that opportunity, where the growth is going to come back, the valuation is reasonable, market is worried for next 3 months. But if we are allocating capital, which is 3 to 4 years, that's what I thought is all about. Definitely, there are pockets of opportunity, right? And this is one such another data to stock. This is stock specific, but the idea behind is just to say, even in the larger names, the opportunity can still exist. So to end the entire conversation, let's move on to the next. Conclude, move on to the next. Indian economy is in a great shape. I think if you are a medium-term investor, which is like 4 to 5 years to 7 years, right? A fantastic economy. And I think no evidence of this time where we see our neighboring countries, right? They're going through a lot of problem. I think we are very well controlled both on inflation and the growth, very stable economy. I think that's a extreme strong pillar. Coming back as an allocator of capital, corporate India, they are in a finest health, both from banking and the balance sheet of corporate India, and they're growing, right? That's very, very important because long-term corporate India growth will get reflected into our value. And finally, after 18 months of consolidation, we believe it's not a cheapest market. We are not going to say thumb the table and say put all the money now, but definitely there are pockets of cheapness and pockets of expensive. As long as we have a 4-year capital, I think there is enough opportunity to deploy reasonably and compound capital at a reasonable expectation, right? As I told, India has delivered 12-13% over a long period of time. Our endeavor is to do between 12 to 15 on a risk adjusted will be much, much better. I think that should be a very good place. Having spoken all that, right, to last slide, just to share how we have delivered, because finally the question will come back, how is iThought team is performing? We have built a fantastic team in the last 4 years, right from founder Mr. Sham, and then we are a 10-member investment team, right, 4 fund managers and 5 analysts, primarily CAs and CFAs. So we have 4 strategy. One is multi-cap, which is a solitaire. We are very proud to share with a lot of humbleness, with all the support of our clients and good well-wishers. We have done reasonably well. The most exciting thing is last 2 years to 1 year, where it's been a very tough market, right from record interest rate hike, war, COVID, many things we have seen. And we have done 8 to 10% better than the market. This is even without adjusting the risk. Beta for most of our portfolios are 0.7 to 0.8, right? So we are very, very low in beta, low in churn, reasonably very high on alpha, right? So I think we have done a reasonable job. Our whole commitment is if we have 4-5 year capital, I think India is throwing a lot of opportunity. Solitaire is a multi-cap, True Blue is a 100% pure large cap fund. Vriddhi is a small and mid cap, PE style investing, and I think clearly last month was the proof of the pudding. Timing of the market is very, very difficult. Last month the fund did 12% vis-a-vis the index did 3% or 3.78, right? Clearly reflects bottom up investing. And then we have a fantastic product called Spear. It's a multi-asset product which we have been doing through RA for last 5-10 years, and finally we converted that into also a PMS. Fantastic start. So these are the 4 broad solutions we serve clients. But in sum and substance, we generally attract capital of 4 to 5 year capital, and we believe in India as a fantastic opportunity for any investor with a 4 to 5 year. With that, I would like to conclude our session, and we'll open the floor for question. Thanks for all the time given by you patiently listening. We'll be very happy to answer broad question. Would like to refrain from any stock specific. That's primarily that's all. So over to you. Thanks all. Ganesh, you can be in that performance slide. You can just keep that performance slide up. Okay, I'll start off and I'll take Ganesh help as and when it comes in. So 1 second, I'll just start from the beginning. Just give me a moment. We are yet to be okay. We have begun all that stuff. Fine. Okay, what's the full form of? Okay, it's cost of equity, sir. Sorry, I think I should have put it in the down. Basically, you take money, right? So money has the opportunity cost, and when the company delivers more than the opportunity cost, that's where the value get created. So CO is cost of equity. Someone has already said thanks. Excellent, thanks. Excellent presentation, very valuable inputs. Your thoughts on agri and textile industry? Broadly, I think the revival of agri should happen, which is basically, as we alluded, we have a good reservoirs, and I think the monsoon factor will be there. But I think over last 6-7 years, we have built a lot of infrastructure of having the water reservoir. I think slowly and steadily, our monsoon dependency on agri is going down, but obviously it will have some impact. It has to be case specific. And textiles, I think it's going to be a little more better in the medium term. The near term picture is a little more hazy, primarily due to the Western economies are slowing down. But the medium term picture is very, very solid. And I think there is definitely big focus on the government to scale, because again, textile is one industry which is very people intensive. Scale is very, very important, and now a lot of players are trying to scale up self in terms of the number of capacity they're putting in. So last week I was in Bombay, met a couple of textile founders, and clearly in the medium term, they are very, very bullish about doubling sales in the next 5-6 years. But obviously in the near term, it could be a little more hazy. But it has to be stock specific. Very few companies have consistently delivered ROEs about 20%, right? So we have to be very, very specific there in textile. According to you, how many years in midterm investing? So midterm, typically a 4 to 5 year cycle, because equity is not a linear return, right? So clearly, we are very, very clear about all of them have to align, right? So I get right shareholders from you. We also give it to right company with 4-5 years, right? A lot of short-term noise get away. And finally, in 4 to 5 years, what happens? The fundamentals and the price of the company get converged. That's where I'm saying, if the money comes in the right time frame, what happens? We can actually see the benefit of India doing well, corporate India doing well, and that's get reflected in the portfolio. So the initial 1-2 year is a lot of noise. There could be a period where stock price tend to go very fast than the fundamental, and that credit should not be given to us, right? That's more of a randomness. Similarly, there are times where the stock price might not go, even though fundamentals are improving, which happened in ITC, right? ITC FY 2017 was all-time high profit, 2018 was all-time high, 2019 was all-time high, 2020 was all-time high profit. The company was consistently delivering all-time high profit, but the stock did not go anywhere. People concluded it's a meme stock, nothing will happen. But finally, when the technical reason went off, the stock doubled or it moved 140%, because the fundamentals are always solid, right? Today also the stock trades more than 3% dividend yield after the rally. So clearly reflects we have to be a little more patient. That's where I think 4-5 years is a very good time frame, where all the judgments can be formed, whether the house has taken right call, the performance is solid and robust. That's where I'm speaking in the long term. Solitaire with close to 4 years, we have delivered 21.43% vis-a-vis markets 18 with 0.7 beta, right? So if I adjust the beta, we are like 600-500 basis over the market, which is a very healthy performance in our view. This is all post fees. So I hope that answered your question. So what's a medium term? Second top one, country risk. I think every country will have the risk. I think we are in a decent economy. I think the risk is a little more minimal. Definitely some risk we do come, right? Who saw COVID will come and we got locked down. So I think risk is always there. Uncertainty is always there. How do we manage uncertainty is more important than the uncertainty itself. So how do you think defense sector will perform going forward? I think definitely there is impetus on defense, no question. But what we have to differentiate as an investor is a high prospect sector, not necessarily a great investment idea. So let me go back and share some example of what happened in wind energy, right? A lot of company in the last decade become very, very aggressive, putting capex, thinking the way only forward is wind. And we saw the biggest guy actually lost down and then came back, right? So instead of talking big themes, all we think is investing is all about find company which has a durable business, right? Has a customer base. The customers are completely reliant on product, right? Find that sector and they're growing at healthy double digit, right? So India is growing at 11, 12%. So if a company is growing 15, 20, any sector, but finally, are you making profits? So grow the top line. So grow the top line, grow the profit, convert the profit into cash flow and deploy the cash flow prudently, right? This is what we see in every company. We are okay to invest even into defense, but if you see defense sectors could be lumpy. It comes from a policy action, right? So we have to be mindful. But I think definitely the sector is really, really right. At a right valuation, we'll be very, very attractively investing into it. Why automobile sector is having such a good number? What are the factors? I think automobile had good numbers because they did not sell anything during COVID time. We got locked down first. And when we came out, the chip conductor issues happened where they were not able to even produce, right? So the demand was there and they were not able to produce. And the proof of the pudding is one of the large company launched a SUV 700, right? People have to wait for 1 year, right? We have gone back in times where we have to wait to buy our product. So I think now everything is done. Production is there. Demand is there. Production is yet to revive fully. That's why the numbers are very, very robust. And all of us also want to buy vehicle, right? Because last 4 years, Indian economy just come back and people are finding more confident among themselves. Thanks, sir. This. Ganesh, my question regarding is Anne's company. Can you throw some background on how you choose that? If India's risk-free rate reduces, will you change your? Obviously, right? Where cost of equity is a function of risk-free, which could be a 10-year GSEC or a treasury bill. Then you add the beta function, right? Which is the market risk you add into it. That's how the cost of equity. If the India risk-free itself goes down, definitely cost of equity will go down. I think the biggest positivity will happen in next 7-10 years is structurally, we might see the cost of equity can go down because I think the supply side economics will going to help us to have a very benign inflation environment. And more we are going to have a benign inflation environment. The beta of our economy goes down and that produces a slightly lower cost of equity, which is going to be pretty positive for all long-term assets, right, from equity and real estate. But I think it's a medium-term picture and not a near-term picture. Hope that answers your question, sir. What's the government interested in consumption-oriented economy? Whether government, I think government is definitely interested in every part of the economy, but you have to be mindful when you're in consumption, right? And when we have inflation, what is inflation, right? So people are buying more goods. That's where the price have gone up. You cannot actually now dole out something because the RBI is raising rates to bring the consumption level slightly lower. So when you have high inflation, right, expecting government to push consumption is a counter-cyclical measure. And that's what we have seen in the last 18 months, which is a very good news. They did not do any dole out to a lot of public so that they go and buy because already government is fighting the inflation because inflation is not healthy at a rate of 8-7%, right? We need inflation. A 4% inflation is what India is endeavoring with a range of 2 to 6, right? So our inflation is slightly elevated today, close to 5%, but we are much, much benign than what the Western world. So I think once inflation comes down, I'm sure with the construction activity picking up, it's a question of a time where the entire economy will get revived and consumption is also expected to revive. Thoughts playing, what is the hospitality theme? Which part of the value chain is good to participate? I think hospitality is again a very cyclical theme. A lot of themes have run up. So we are not here to suggest which stay names, but the whole idea is the merit is you need to be sticking to themes when they were a bit down, right? So as a house, we were very bullish during the COVID pain. Also, we held on to our hospitality stocks because the ROE got plunged. There was no operating metric, but we know these are very competitive company. They will come back. And now in the last 2 years, we clearly saw the revival of the economy, and then the stocks fired. But definitely the movie is half done. Huge revival has happened. So you need to be very mindful on if we are getting into a stock like hospitality now, but definitely it's worth paying attention. Every stock is from a right valuation. You cannot buy any sector irrespective of valuation. Can you please share the breakup of Nifty EPS company wise? Sir, you can actually message us and I'll try to send it by mail it to you. The top 50 names and their EPS. Hope that answers your question, sir. Which sector is costly and which one is attractive? I think the consumption theme with 60-70 multiple, you have to be mindful. Saying that these are free cash flow business, they will grow. The past data doesn't suggest they have grown at 20%. So I think if you are sticking to a portfolio which is at 70-80 multiples, ask your question, why are you paying so much? And what are you seeing that which nobody is seeing it, right? So I think some stock specific actions, which is called high quality, buy at any price, we have to be mindful on the theme. And definitely there are a few sectors, as I suggested, right? Think about IT, clearly very profitable, but today nobody is watching, right? So if you are a 1-year investor, you are never going to buy IT, right? Because there is nothing good news is coming out. But if you're a 4-5-year investor or a 10-year investor, right? Think about one sector where the right to win proposition is very high for India is IT, right? It's a torchbearer for exports. A classic case for last 20 years, they've compounded capital, huge wealth creator. So you know the sector is a good sector. And today is a downturn. So if you have a 5-year money, you will start seeing hunting at least, right? At least the starting point is to look at. And there are many more sectors, right? So we are favoring a couple of sectors, which is similar structure, high free cash flow, in savings business, where we find we are buying business at 4-5% dividend yield, right? So very good position. But only thing is, these are business going through a temporary problem, but a long-term extremely positive, right? So that's what we need to look in. And that's what we end up doing it every day in, day out. Thanks, sir, for your comments. Which gives you level EPS 50 company that attribute to Nifty approximately 1,000 now. I think the Nifty EPS we closed between 820 and I think the next year will be close to 920 odd-ish. That's what this is an expectation, obviously, right? This expectation keeps changing based on how the economy is functioning, how the markets are functioning. Is there any industry or company that may not be affected by de-dollarization? I think every industry will have some or the other effect, but the whole idea is India is a growth economy and you have a lot of ideas. So we are generally a bottom-up house. We do look at macro, but all we believe in is if you can find good company which is going to serve the customers well, sell more, sell better, generate cash, and use the capital efficiently and available at a very reasonable valuation, right? So as long as you find such idea, with the 4-5 years, I think there is definitely some money to be made. We don't really get perked up because there will be always 101 variable will keep coming and people keep telling this is the most important thing. Yes, it's most important thing for next 30 days and the least important thing for next 30 years, right? So the whole idea is what type of a money we are bringing in and what type of a time frame we have. I think macro variables are important, but I think micro is even more important because as long as you find a good company with this metrics, right? You end up seeing, and you saw every 5-year cycle, you see, irrespective of market, there is always some 10 baggers, there are some 5 baggers, there are some 2 baggers, right? And then we have ITC. So the whole idea is let's find out, invest with a medium-term perspective, compound capital at a decent rate. How do you see Russian oil money which is sitting in India? Would they be investing the money? How does it impact? I think India has got now getting insulated from money coming in only from FI. The good news is we are having a record SIP flow, right? So the 401k movement has happened in India. I primarily initially worked in mutual fund. Now I'm part of the investment team in PMS. We used to have a SIP flow of 1,000-2,000 crores. Today we are having SIP flow of monthly 14,000 plus odd crores, right? So clearly the moment of Indian investor investing in India has come true. Think about 2 lakh crores of a SIP money coming every single year. A fantastic flow, consistent discipline money. I think that's why last 18-20 months with FI selling big time, we did not correct because now the balance of power is not only with FI, even domestic has come back and it's going to get even more pronounced in the next 5, 10, 20 years. So I think the big picture is our savings are getting translated into good channel and India is firing, right? Both economy and the corporate. I think that's where the positivity. So I think that's all we are seeing it. The performance which you have shown, it's CAGR. Good, President. Thanks, sir. About a view on AMC and insurance. So we are slightly taking a positive view on both the sectors, keeping the medium-term perspective, right? So India has banked more than 100 crore people have bank. But if you look at AMC, right, only 3 crore people have a mutual fund account, right? So we have not even touched the surface. And as far we ended, right? So we ended 272 lakh crores, which translates into $2,300 per capita, right? So when the per capita moves from 2,000 to 5,000 to 10,000, right? The huge transition will happen from the past vehicle of saving to a new vehicle of saving, and we are pretty positive in the medium term. And few businesses are extremely high on free cash flow. So you end up buying business with a 4-5% free cash flow, and growth rate will accelerate in the medium term. I think we are reasonably positive, but it's a case specific. Can we take up service in MF? We cannot. Of course, sir. I think so. A PMS is 50 lakhs. Definitely, as a house, so we are serving clients even from 5-10 lakhs to 50 lakhs in the mutual fund. So we'll be very happy to do our service rendering there. Obviously, there we will not use our PMS vehicle, but we have a fantastic team which does deep work on the mutual funds. We have a 15-year track record on mutual fund side. So we use the other tools like mutual funds, direct option, or other options and ETFs to build a good portfolio there. Our team can get in touch. You can get in touch with them. I think that answers your question, sir. Can you answer this? The performance, I've answered this question, sir, on performance. What is the impact of technology stocks? We are more of a service oriented in IT sector right now, slowly moving to production. I think both the things are firing. I think if you see, even yesterday CI conference, they commented that the soft thing is our service exports is a record high, right? Continue to be a very strong service economy. It's not only IT, right? Actually, the high-end service of legal, compliance, ESG. So there are a lot more services actually getting exported from India to global, right? So these are very high per hour basis, right? So India is moving from a very low-end IT service alone to some higher end. But interestingly, the production economy is also picking up. The government is full thrust. That's what I'm saying. Now the growth is getting broad-based. Instead of sticking with 70, 80 multiple portfolios and saying these are only 20 stock performs, there is clearly an opportunity to have a broader portfolio which can perform very well. And opportunity is actually in multiple pockets now. Not like 4 years back where the opportunity was only existed in selective pockets. Hope that answers your question, sir. Any more questions? Or if you're done, we'll wait for another 2-3 minutes. I think we have answered all the questions, looks like. Thanks, sir. Hope you like the data. So the whole idea is to share database decision making, right? That helps us to build right portfolio. And we'll be very happy to serve anyone interested in any of our platform. The idea is to share the data and how corporate is doing well, so that if you are already an existing investor wherever, right? I think next 3-5 years journey is going to be very good. This will come with its own bumps, but in terms of if you have the medium term perspective, I think India is very well positioned. I lost your voice. Could you please repeat? It's a CAGR, sir. I think the performance is CAGR. If there is no, okay, thanks. If there is no, okay. Thanks, Ganesh. Thanks, Tarun.
Thank you, sir. Thank you, everyone, for joining us today. Thank you, Tarun.
Thank you, Mr. Ganesh. Thank you, Mr. Balaji. And my dear attendees, thank you all. Hope this was a very enriching session for you all. So for any queries, questions, issues, or doubts, you can always contact us. Ganesh will go to that slide right now. Again, happy weekend to you all. Thank you and have a nice day. I'll be posting the email as well as the number on the chat board for your convenience. Thank you.